Hey everybody, this is Scott Arnell and welcome to this episode of SRI 360, where in every episode I interview world-class sustainable and responsible investors, executives, or entrepreneurs who are driving positive change in the world while achieving market returns. And I do this to bring you the lessons that they've learned along the way from their investment activities and their experiences, so you can find out what they are actually doing and how they're doing it, so that you can have better insights into the different SRI investing strategies that are actually being done today and across many different asset classes, and hopefully in order to help you invest in a more purposeful way and to invest for positive impact and for a better world through your investment activities. Today, I'm speaking with Jenn Pryce, and that's spelled P-R-Y-C-E, and she is known as Jenn to those who know her well. Jenn Pryce is president and CEO of Calvert Impact Capital in Bethesda, Maryland, and Calvert is one of the oldest and most well-known global investment firms in the community investing space. They have a 25-year track record raising capital from both institutional investors as well as retail investors, meaning investors just like you and me, and they have raised billions of dollars to proactively finance solutions to climate change and inequality around the world. During Jenn's tenure at Calvert, she has shaped the strategic direction of Calvert Impact Capital to focus on innovation, sustainability, and scale. Since Calvert Impact Capital's founding, the company has worked with nearly 20,000 individuals, institutions, and advisors to raise nearly $3.5 billion. I really look forward to having this conversation with Jenn, and I think you will enjoy it too. And now, please meet Jenn Pryce. How was the Peace Corps in Africa? How was that?
Tremendous. For me personally, that was probably my first understanding of the idea of the community over the individual.
Right.
And grounded the idea in my head of the power of community.
So when you say that's the first place you really learned about community, how or what did you see or what did you experience?
Yeah, where I lived was a rural village. There was no water, running water, no electricity. And the men would go out and hunt. The women would work in the fields, and people would come home in the evening to cook as a family. And I didn't have a family. And so I ended up paying a family to be part of their family. And I would go to their house at night and be part of the process of preparing the meal and eat with them. And it was just very clear in these simple acts that working as a community is how one truly survived and even was able to thrive. And that was not what I had experienced growing up in America.
Interesting. How many years did you do that?
Two. I was there 2 years and then came back and worked for Neuberger Berman. Then I got my MBA, and then I went to the investment banking division of Morgan Stanley in London. And that was another kind of just a puzzle piece coming together for me personally. I was working when deregulation of the energy and utility sector was beginning in Europe. And so one of the transactions I worked on was the acquisition or potential acquisition of the Spanish utility of the Portuguese utility, and spent a lot of time modeling, making the numbers sing, so to speak, to recognize well down the path of the transaction that the numbers were one piece of it, but the cultural disconnect or connectivity between the Portuguese and the Spanish was another very important part of that transaction that no one had really considered or thought through. And it created a lot of inability to close. It prolonged, it delayed, it even thwarted the transaction at times. And so that was another just puzzle piece coming together for me, that it isn't just about numbers, how companies and businesses come together or thrive. It's also about culture and people. And that had never been modeled. It had never been discussed. So that was a powerful moment. I think that really did make me question, am I learning all the skills I need right now in the role I have at Morgan Stanley to be successful. And I said to myself, no, but I didn't know what I was missing. So I left and I lived in Australia for a year, lived in Byron Bay, was part of a yoga program that was a teaching program. I learned to become a yoga teacher, and it was much more intense than I had thought. It started at 5 and ended at 5, and that experience brought me back to Washington, D.C., where my parents then lived. And I started my own business teaching yoga. I also then traveled to New York City, where I had spent a lot of my formative years, Columbia and afterwards, and continued to teach yoga and also volunteered at the Public Theater. And this is where another puzzle piece came together for me. The Public Theater, it was founded by Joseph Papp, gentleman who could not afford the arts growing up, and as he came into wealth, believed that everyone should have access to the arts, that they should be democratized, not just for the wealthy. And so he created the Public Theater, and it was, when I was there, a vibrant time of art. It was Angels in America, George Wolfe, Philip Seymour Hoffman, who has passed, but he had a theater there called Pig Latin. It was just amazing. But at the same time, it was financially crumbling. They had brought in a woman from Ford Foundation to revive the Public Theater, and it was on its last legs. I went to go to try and find financing for the theater, and no one would give me a loan because they didn't own their building and they didn't have strong enough cash flow. And that, again, was just a disconnect to me. How can we not find a way to properly finance institutions like this in our society? And so from that, I learned about community development financial institutions, which are unregulated banks throughout the United States. And I went to work for one, the Nonprofit Finance Fund.
Yeah.
And I worked out of their Washington, D.C. office in a neighborhood called Columbia Heights. And that was a gentrifying neighborhood in D.C. at that time. And my role was providing loan capital to the arts, schools, healthcare clinics, the anchor institutions that would keep that community grounded in culture. And I did that for 5-6 years. And then the big box retailers like Best Buy and Target moved in, and I knew my work was done. You know, the price of real estate had escalated. There wasn't a role for community lending in the way that I was doing it anymore. And so I came to Calvert Impact Capital about 12 years ago. I was intrigued by the global posture of the work they did. Still today, we reach 100 countries in all the states across the United States through the work we do. And that was, I found, really intriguing.
You started out at school in engineering.
Mm-hmm.
And then you went and taught maths and so forth. But then it's pretty consistently you've migrated to finance, and to this day are in finance. People like myself who've been a lot in finance, I've also been in general management, but don't stop and think. And all day long we're working with people in finance. But was this always an idea for you, or was this something that just, yes, all of us came in different ways, and sometimes it was planned, sometimes it's serendipitous, sometimes it's, I need a job, I'm out of school, now I got some bills to pay.
No,
how did you end up in finance?
Yeah, no, it was a great moment for me. I came back from the Peace Corps, and quite frankly, when the Peace Corps brings you back, you're paid by the US government as a Peace Corps volunteer, comparable to the wages of the people you're living with. So you're not building wealth. You're just paying your ability to eat and survive. So you come back and they give you a small stipend to reintegrate. I chose to reintegrate to New York City. That stipend didn't go far. So, I quickly had to find ways just to make income. And I called a temp agency and I said, are there any temp jobs? And they put me in a short-term temporary assignment at Neuberger Berman.
Okay.
And it was fascinating because I worked for this amazing man named Harold Newman, who he was a financial advisor and had a book of clients that were very well known, very notable, and they trusted him dearly. He was an older man, had been in finance for decades. And the reality is one of his assistants, her husband was dying. And so she needed to take a short-term leave to be with him. So I was there for 2 or 3 months. Within 2 weeks, he said, holy, moly, you get numbers. I said, yeah, I love numbers. They just make sense to me. And he goes, can I bring you up to the equity research floor? I think this is where you belong. And so he brought me up there. And back then it was semiconductors, the big three, right? Automotives, and paper and forest products. This is this industries that were still sectors at that point. And I met the analyst and spent time with them and started just creating financial spreadsheets, and an opening came about up there, and I quickly was hired. But it was Harold. He really looked at me and said, you're going to do well with this. You get it. And I want to make sure that you stay. You're an asset to our field. So I was really fortunate that someone connected me to a role that really brought me joy and suited the strengths that I have, math and quantitative and curiosity. I felt equity research was just really fun. You're asking questions, you're figuring out a puzzle, it's great.
That's also a piece of history. I guess they were acquired by Lehman, no, at one point?
They were, and I was actually there when Roy Newman was still there, Roy Neuberger. He must have been 100. And I'll never forget meeting him in the elevator. I used to walk to work every day. And it was true. He went to this office and he'd sit there and he'd walk home. It was an independent entity at that time, and really the founder was still there, and it had a lot of heart and soul, a lot of care about what it did and how it treated its clients.
So then maybe we can start with an overview of Calvert Impact Capital.
Yeah, and I'll caveat this that we're in a moment of great transition as an organization, which is probably no different than the field of impact investing.
Yeah.
We've been around 25 years. We are a nonprofit financial institution, so our legal form is a 501c3.
Yeah.
We recently extended our corporate structure, so there's now a holding company called Calvert Impact Capital Charitable Inc. And we're building new products and services, both for-profit and nonprofit, under that holding company. Also under that holding company is Calvert Impact Capital, which holds our flagship product, which is the community investment note. And the reason we do our work is to connect private capital to communities. And so providing financial products, providing education and access to impact investments is what we do. Right now, we do that through providing financial products. We have a syndication business. We work with others to aggregate capital. We are a leader in impact measurement and management. We manage other people's money through various fund management roles over the years. And as I mentioned, we're right now growing new products as we see that there's gaps in the market.
And then what's the relationship between Calvert Impact Capital and Calvert Research and Management?
There is no legal or financial relationship. We were incubated within Calvert Research and Management before we spun out and became a 501c3 in the late 80s, 1980s. The founder of Calvert Research and Management, Wayne Silby and John Guffey, also founded us. They've also been luminaries in the impact investing field. They have founded or established a lot of other entities. We have John Stroyer, who's the president of Calvert Research and Management, who sits on our board today. And we share a brand that is codified through an agreement.
So within Calvert Impact Capital, which is what we'll be talking about, just help me understand, do you have separate funds that you're managing, or how are your activities structured?
We have a flagship product the Calvert Community Investment Note.
Right.
The capital we raise through that product is full recourse to our corporate balance sheet, and it's the senior note position. We then lend or invest that capital that we raise in a diversified portfolio. Right now, and that's an open offering, so we're always in the market raising capital. It has a prospectus that we issue annually. And right now, we have $600 million roughly in US dollars. Over time,
how much did you say? Sorry?
600 million.
Okay.
Right now, in a moment in time. Over time, we've raised $2.5 billion through that product. So that's been our flagship product, the engine that drives.
Could you paint the big picture or give me a big picture overview of what the community investing space looks like for someone who doesn't really know it? And then where does Calvert fit into the overall space?
Yeah, so if you think about, in general, what we invest in, what the community investment space invests in, is investable opportunities that traditional banks don't do. So this is what JP Morgan doesn't do. Affordable housing projects, microfinance loans, renewable energy that's new and novel, rural communities, Black-owned businesses. There's something about each of these transactions where the perceived risk is higher than the real risk. And because we work close to these communities, we understand these markets, and we have increased comfort investing in these businesses or these projects, so we see a different risk profile. And so to move the money into communities, what we have found is there's a whole bunch of private capital over here, that there's a set of community intermediaries that are working with that private capital. They're offering them products and services and education to invest their money in another set of intermediaries that are community-facing intermediaries. These are microfinance institutions, affordable housing developers, community development, small business lenders. They sit in communities, they sit close to the projects. And a whole bunch of us that sit here, like Blue Orchard, like Responsibility, like Calvert Impact Capital, we're raising money from investors and investing it in these intermediaries and impact funds that are sector or geographically specialized, and they are finally on lending it to businesses and projects in place. Unlike traditional finance, there's a lot of intermediation to move this capital into community.
All right, so are you very similar to Blue Orchard, for example?
Yeah, we sit much closer to Blue Orchard, to a Responsibility. We are creating investment products to bring private capital into impact investments. But we are not making a direct business loan. We are not investing directly in affordable housing project. We are investing in intermediaries that then lend to the business, to the project, to the person in place.
Where do you fit in, and then what is there a difference between you and the other players? So who are the big players that are similar to you, and then how are you not similar?
A few things about who similar to and where we sit. This little silo we're talking about, the Blue Orchards, the Responsibilities of Calvert Impact Capital, what we're doing is we're structuring products that meet investor demands, right? They have demands around liquidity, around risk diversification, right? No investor wants to have a direct investment of $5 million in Tanzania, right? Investors want an investment that's 5 years or shorter. However, many community investments are 10, 20, 30 years in duration. So we're solving for that problem. Size, an institutional investor, they don't want to make an investment less than 10 million. So you need product that has enough size that they can take a meaningful piece of it. So we're solving this problem by aggregating, structuring a product that really meets those investor demands. And yes, Someone like Blue Orchard is doing something similar. Us, responsibility. And then the list gets very thin. This is where we don't have a lot of actors. And to me, this is one of your questions. What is the most challenging problem in the impact investing space? It is this. We don't have a lot of good ways for mass affluent, for advised assets, right? A CIO that oversees a pension fund or a financial advisor that oversees a high net worth individual's client portfolio to really invest and engage in impact investments unless they take the time to underwrite and do diligence a direct investment themselves, which many people don't have the time, the capacity, nor the fiduciary bandwidth to do. So this is a thin piece of the market. And more, even though I would say we're a peer with Blue Orchard Responsibility, they design their products for European regulations. We're overseen by the SEC in the States and the US, and we raise US capital. So we're similar to different audiences. And so if you look in the United States, there's other players that issue community investment notes. No one's as big, no one is as established as we are. We have distribution into the large wirehouses, so we're wired in the walls. So a financial advisor can go to the Merrill Lynch platform, find our note and put it in client portfolio and have it electronically. It trades at par, there's daily liquidity, so mutual funds can buy us. That whole distribution feature is very unique to us. Many other community investment notes just sell it directly to investors, right? You fill out a paper form and mail in a check. So it doesn't have wide access for investors. There's some other. Equilibrium is a private equity fund, as well as they have some debt vehicles. There's something called, there's other funds like Jonathan Rose in the United States. He has an affordable housing development fund. But all these other products are for accredited investors only, or qualified investors. They're LPGP funds, so often they're PE, so they fit into the alternative asset class. There's very few other products that fit into the fixed income or into a cash alternative bucket. So it's a growing space, but there's still a very thin product selection. And it's where it's just it's hindering money to easily flow out of client portfolios into true investments.
You are accessible directly retail, right?
Correct. You can go online and buy a note for as low as $20.
And I don't think Blue Orchard is.
No, they aren't.
Okay, so I got it now. But what people want to know is, what are professionals like you doing? And we understand the high level what you're doing. But people want to know, so really, how are you doing it? How are you deploying capital?
Yep.
Yeah. So what happens when you start making the sausage? Okay.
So when we start making the sausage, as you said, we have a retail investor base. So our risk tolerance needs to respect a retail investor. So we're quite low risk.
Okay.
We aim to have a diversified portfolio across sectors and across geographies to minimize that risk. And we look to intermediaries, both because operationally we're all in Washington, D.C., we're not in the field. So making a direct loan in Tanzania or in South Africa it's a riskier proposition. It doesn't align with our risk profile. So we lend to intermediaries.
You don't have any offices anywhere outside of?
Nope,
okay.
This is it. And we travel a lot, but this is it. And that's our theory of change too, is that if we can create impact funds, financial institutions in communities where there's not good access to capital, if we can capitalize them, then that's a sustainable, reliable capital source for those businesses in place.
Can you give me an example just one example that ideally captures your strategy in terms of someone invests in you and then you take that money and then what was the impact both from a financial perspective and then from an impact perspective?
So we lend into 9 impact sectors. So just as a headline, we have a different theory of change for each of those sectors. Small business, affordable housing, renewable energy, etc. An investor can target their money to any of those sectors or untargeted, so they just support the whole portfolio. And so a very typical investment for us would be in Africa. There is a group called Sun Funder. They are headquartered in Kenya and Nairobi, and they work across the African continent providing businesses that provide pay-as-you-go solar capital to expand and grow. And so they're putting solar home units on individual homes that are not connected to the grid and providing solar power to hundreds of millions of people. That business model, pay as you go, where an individual leases to own a solar panel, was a business model that none of the banks in Africa felt comfortable investing in. And so Sun Funder is a new fund manager that emerged probably about 8 to 10 years ago now to do that type of lending because none of the banks would do it. We were one of their first investors. We were a debt investor in a blended finance vehicle, so there was equity and other investors beneath our investment. And they've lent that money out and helped grow that renewable energy sector, the pay-as-you-go sector in Africa. Fast forward now, there's other Sun Funders across Africa, right? Other impact intermediaries doing the same type of work. The development finance institutions have heavily helped grow and scale this field. And now Standard Bank and other banks are starting to lend to these social enterprises, these businesses that are providing the pay-as-you-go. So what Sun Funder did is they demonstrated that these were investable assets. They built a track record, and then they went out and was able to share that with more traditional finance capital sources that could scale and grow the sector. And so we have about 70 million of exposure to sub-Saharan Africa, solar renewable energy. And we probably won't do much more because we've been in there as an early investor, used our capital that demonstrates investable, crowded in a lot of DFI money, and now the traditional banks are coming in because they're comfortable with that asset. And to us, that's victory. Then we can move on to a new asset that people don't understand or where the economics don't make sense to them because, again, they think the risk is much higher than the real risk that we see. And so we'll take a much lower return for those investments and build a track record in those assets as well, and hopefully pass them off as well. Some pass off, some don't, right? It's taken 30 years for microfinance to grow and scale and access capital markets. It's taken renewable energy in sub-Saharan Africa a decade. Sustainable agriculture is still a broken market in some places. So these are long-term. This is a marathon, not a sprint, but that's what our portfolio is doing.
So when you invest in Sun Funder, is that
Yes.
a debt instrument? Is that equity? What is it?
It's a debt instrument.
Okay.
There was equity beneath us in the instrument as well, but our investment was debt.
And you only do debt? Is that?
We have a few equity investments, but this goes back to just the profile of our investor being retail, so needing to keep our risk low.
So I guess the devil's always in the details, and it sounds like your model all depends on you working through MFIs or community development financial institutions, because you can't do this all direct, right?
No, and there's these intermediaries exist in all the different sectors. And so, you know, it's hard to say what a typical transaction is because that intermediary lending, the type of investment we're making is consistent, but the shape, form, and structure is it varies. So like we were the first investor in the Seychelles Blue Bond. That was issued by the government of the Seychelles. So it's a general obligation to Seychelles, it's sovereign debt. but it couldn't float in the capital markets because it was only $15 million. So this was not going to hit any sovereign desk. It was too small, and the yield they wanted for the risk of the rating did not align. And so us and two other institutional investors took that down. So, the blue bond, we have a sovereign blue bond in our portfolio that doesn't look structurally like some funder, but it's doing the same thing. This was the world's first blue bond. Someone needed to take the risk and demonstrate that it was investable, and we did that.
Okay, yeah, before we get too much further, we keep hitting on this. I want to get it out on the table here, this community investment note. What is it and how does it work?
That's our center of gravity right now. It is our flagship product. It's a fixed income product. It looks like a corporate bond. We sell it in 1, 3, 5, and 10-year increments for rates right now of 0.4% to 2.5%. You can access the community investment note 3 ways. One is online. You can buy a note for $20. You can buy it through your brokerage account. So you can go on the Schwab or the Fidelity platform and for $1,000 minimum, buy a note. Or you can just directly write us a check. And we have a track record of 100% repayment of principal and interest over the 25 years that we've been issuing the note. And the growth of the note has been exponential. It's 600 million, outstanding balance now. In 2017, it was 350 million. If you go back, it was smaller and smaller. We're always in the market raising capital, as I mentioned, always in the market deploying capital. So there's a sales team here of 4 people, 5, that go out, they work with financial advisors, they work with institutions, they educate them about impact investing and our note.
I've read that somewhere that your historical repayment rate is 99%, but investor repayment is 100%. So where's that 1% spread?
Go, yeah.
Where's it come from?
It's a great question. So when I say it's like a corporate bond, that's because they're buying our balance sheet, right? An investor is investing in the balance sheet of Calvert Impact Capital. 80% of the senior debt is the note, and then there's 20% of subordinated debt and equity beneath them, net assets. And so we have that buildup of net assets and subordinated debt where if we have losses, we can absorb that loss and it not impact the senior note holders.
Okay.
And that gives them great comfort. So when someone considers buying the note, it looks like a corporate bond. It has a QSIP. It trades at par. And they look at the track record of our portfolio, the diversification. They look at the subordinate capital beneath them. And they get comfortable with that risk profile.
Do you feel that these are risk-adjusted returns?
The money in or the money out?
The coupons you're paying, because you are operating in what some people might refer to as funny places.
I do, because of our track record of 100% repayment over 25 years, because of the subordination beneath that senior note offering, because of the track record of repayment on our portfolio. I feel like we've demonstrated that we're operating in funky places, but that they're investable assets and that we are built for purpose. So the team that's doing this work understands these markets, understands the people we're lending to. We have a rigorous due diligence process, and that's all really important in being fiduciaries of their capital.
Now, I think you might have hit on this before, but I think you have 3 main strategies: balance sheet loans, structured debt, and asset-backed facilities. Is that correct?
So that's more just the products we offer. We can do anything. We have a bucket too when we report to our board that's called other. So that's more of a way we just look at our portfolio through a lens of risk. We divide it by what geographies that it's in, what type of products we're offering. Our strategy is build, grow, sustain. And it's really looking at new, growing, or sustaining intermediaries and providing them the capital so that they can grow and scale.
And do you use blended finance?
Everywhere.
Yeah.
Every transaction has a piece of blended finance in it. Every single one.
Okay, and so I mentioned before that all of this depends on your intermediary network. How do you do due diligence?
It is a rigorous process. We have 2 credit committees. One is a staff investment committee, another is a board investment committee. And we bring due diligence memos to these committees. The due diligence memo is extremely thorough. It's looking at both impact, capacity to repay, the character, the risks and mitigants. There's a pricing model because we do risk-based pricing, and there's a risk analysis that's based on ELR, probability of default modeling. And so it's extremely comprehensive. And we also then, once we make our investment, if it's approved, we do quarterly monitoring, both impact and financial. We do annual monitoring, and we have a very robust process to manage impaired assets. So a classified assets, an actively monitored list. We always visit our clients. We do due diligence site visits when we underwrite them. It's been a little difficult in COVID. And we also travel and meet them at conferences. We talk to them on the phone. Many of our investments, if it makes sense, right, if it's not a closed-end fund, we renew and grow our relationship over time. So there's some partners we've had in our book for 20 years. And we have grown our investment as they have grown.
And I imagine you're working mostly in developing countries.
Correct.
And I know personally, I've spent a lot of my career living and working in some of these places. And a lot of these are places where the rule of law is, let's say, isn't always the rule. And when there's money involved, there's often corruption, and sometimes on an industrial scale. So how do you vet your MFIs and your intermediaries? Because some of these places, they're professional and they practice on each other.
It's a great question. There's a number of strategies. One, we hedge everything. So if you think about the risk of local currency lending, because we do lend in local currency. If we do any local currency lending in our book, it's hedged. So we don't take currency risk. We also have a country risk model where we've looked and created a framework to divide the globe into A, B, C, and D countries, D being the riskiest, A being the strongest. And we've set limits on how much exposure we can have in any of those countries, very much correlated to their country risk score. So we have that framework. When we underwrite an individual credit, 2 things come into play. Often, a fund manager is working across multiple countries. So that helps to mitigate the risk. And oftentimes with these funds, we'll negotiate country or geographic exposures. So limiting investments in South Africa to 25% of the proceeds they raise, et cetera, and us and the other lenders. So this is not just us, this is the LPs collectively. There is negotiations just around country risk limits for these investments we're making. And then finally, we look at features in our risk scoring model around political stability, ability to get repay, strength of the rule of law, things like this.
And on a similar note, it's not the same, but it's kind of the same. Is there greenwashing? Is that an issue in community investing? If it is a thing, how do you avoid or deal
Yeah,
with it?
it's
Or
where there's greenwashing, I think, in community investing is not having an impact measurement and management process and infrastructure. So there is some community investing actors that just collect data from their borrowers and pass that back to their investor. But the operating principles of impact management, if you've heard of that, and we're a founding signatory, as is 200 other impact asset owners or managers, is we're advocating for people to have an impact measurement and management process. So take your investment at due diligence, how you collect data over time, how you assess expected impact, and looking at when you leave an investment, are you leaving with the impact in a positive place? So impact to exit, they call it. And so it's a whole process of impact measurement and management, and having it support your theory of change, your vision, and your mission is what the operating principles for impact management has been advocating for over the last 2.5 years. And that authenticity, that integrity of how you measure impact, I think is what differentiates authentic and deep impact from more of the reporting and window dressing.
So how do you measure and verify and report impact? How do you actually do it?
The foundational piece is we have an impact scorecard.
Yeah.
And so every transaction we put through our impact scorecard. It has a section on community impact. So looking at the 5 dimensions of impact that the Impact Measurement Project put out, which is best practice and what the field has coalesced around, as well as the ESG of that fund itself. So what their own environmental, social, and governance policies, procedures, et cetera are. So is that fund itself doing positive in the world? That's half of our impact scorecard. The other half is looking at the impact that our portfolio is having. So our investment in these intermediaries, the build, grow, sustain strategy I talked about earlier, we're assessing if our capital is providing additionality, if it's helping scale and grow, if it's tied to our vision and our mission. We take that scorecard, which is a set of questions, and we embed that in every due diligence memo. And it's a point of discussion, as is the ability for that entity to repay our investment. And then once the investment is made, we collect annual impact data. We manage the impact risk of our investment. So if we see deterioration in the impact, we monitor it like we would monitor credit deterioration. And then when we exit an investment, and there's 3 of these on our website right now, we do success stories. So we assess our role in advancing the impact of that investment, that intermediary, that fund.
So this all sounds win-win. No one would argue with what you're doing, but you essentially are lending to people who have been left out by the traditional capital markets. I understand that there's 100% repayment, but are there increased risks in investing in
It's a great
these
question.
kind of organizations and projects? It seems like you've avoided it, although I don't know if you've ever had negative returns.
No, we've had some losses. Corruption happens. What we find is smaller funds run out of equity and can't sustain themselves and go bankrupt. Another big, one we're finding now is if a fund doesn't have personnel in place, if they're all sitting in Germany and lending into Africa, that's proven now for us to produce subpar results, that you need people in communities doing the actual So we've seen, like, I think most things investing, there's patterns. We know our markets and we've seen patterns. And so those risks, because we are able to learn, and we have also data, performance data, so we can actually track how certain sectors have performed over time, all help us inform what we believe the true risk of investments are, not what is perceived as risky by the markets.
I'd like to know, who's your investor base?
It's very diversified. It's institutions, it's individuals, it's businesses. So like corporate treasury, Netflix has money in us, for example. Aflac has money in us. Starbucks has money in us. That's coming from their corporate treasury, their liquidity. So that's an investor base for us. Nonprofit entities have money with us. Faith-based is about a quarter of our investors. Mutual funds, other endowed entities, pensions that manage faith money, about a quarter of our base. So it's very diversified.
Have you observed a change in the types of investors as your AUM has grown?
Yeah, absolutely. One of the big changes for us was about 15 years ago, we worked with InCapital, a fixed income distributor, to get on platform, to get distribution into capital markets, into the brokerage channel. And that has changed significantly who invests in us. That's now where we raise 61% of our money through that channel. And that's a lot more institutional advised client assets.
If you had to name the most important challenge in the social impact investment space right now at this time, what would it be?
It's reaching private capital, creating products that can be easy and accessible to private capital.
And is the issue scale? There's no scale, or there's no distribution, or what?
I think it's a lack of knowledge of how to structure products so it meets investor demand and community need. So there's not many entities that sit between private capital and community and can understand both, and therefore structure a product that can speak to both audiences.
Okay, like what do you know now about social impact investing that you wish you knew in 2009 when you showed up at Calvert?
Such a great question. The investments we're making are solving very complex problems. They're not just an investment. It's not just about financial return. The impact piece is much more than just collecting data. It's about a market that's broken, and it's a complex problem that we're trying to solve. And finance is only one piece of the solution. So you need to work with government. You need to work with business. It needs to be a multi-stakeholder solution at the end of the day. So we can't just be an investment shop. We also have to think about, how does policy help resolve the systemic issue? How can business work to help this issue? And show and demonstrate what we've been doing as an opportunity for people to come along.
I'm pretty sure that DC dinner parties are no different than what we have here in Geneva, and the cocktail stories are always about amazing investments and home runs yet, but not too many people talk about the strikeouts. So I don't know, you don't have to name any names, but if any example comes to your mind of an investment that you were convinced of at the time that it ticked all the boxes, but for whatever reason, it just went pear-shaped in the end. And what was it that you learned from that experience?
Living through one right now where the fund we invested in provided small business loans across the African continent, but they didn't have people in those communities. What they were relying on is the efficiency of technology to help get the right economies of scale, the right economics to make the fund work economically and to get capital into the hands of people. And it didn't work. It is relationship lending. And so the economic model never penciled out. They needed to put people in places, and that cost more than they ever thought. So this idea that small business lending can all be digitized, I now have great skepticism about.
Yeah, like booking your own air ticket on the internet.
Yeah.
Now I'll give you a chance to talk about what home run, an investment that you were skeptical of, either at the time you invested or maybe even passed on, and then in the end it actually did turn out way better than you thought, and you were happy that you invested. Or if you had passed on it, maybe you wished you hadn't passed on it.
Right now, living through one actually again, and it's this role we've played in raising capital for these small business recovery funds that we set up in states across the United States. I questioned what we were doing. To me, it felt like a bridge to nowhere. So we set up these funds, we give small business another loan, and then what? We've kicked the can down the road. Why? What are we doing here? And what's exciting to see now is the federal government is coming out with money for each individual state to dedicate to small business lending, to use it to leverage private capital. And so what we're creating now is a public bond offering. We're working in partnership actually with Morgan Stanley to do this, to create a public bond where investors can buy the bond. The public money is being leveraged, and the proceeds are going to continue to capitalize these small business funds that we've set up across the nation. So now that they can get ongoing capital and recycle capital, they can be an ongoing, reliable, sustainable source for the next 10 years.
So your takeaway from that, you're skeptical, it was bridge to nowhere, but you learned that. What was your lesson learned on that?
That in partnership and collaboration, again, extending across different actors. So it's taking Morgan Stanley, it's taking state governments, it's taking federal money. It's a lot of collaboration, but through that we can create products, we can create ways for private capital to reach these investments. And so to me, the exciting part of that is what this transaction has enabled and what it's growing into being.
Okay.
To me, the whole reason why I do this stuff, it's not just a moment in time, it's to create change that's lasting.
All right. And if there's some young Jenn Pryce out there who wants to get in the social impact investing space, how would you advise her to get into the business? What's the best way to cut her teeth?
I think it's an apprenticeship. You just got to get in there and do it. I have found that they don't teach this stuff in business school yet. There's no course you can take. You just got to go and do it. So find an organization that's doing the work where you feel like that you can be empowered and mentored, and get in it.
Jenn, this has been like super informative for me. I've learned a lot, and you've been very gracious to give me this time. So I want to thank you, and also thank you for the work you're doing. You've been committed to it for a long time, and it's clearly having an impact on a lot of people. And then hopefully, it sounds like there's other people replicating your model out there now, and so there'll be others who will stand on your shoulders.
It's an exciting time to be doing this. I'm glad you're writing the book. It's the next generation coming up that too are going to be inspired. Because like I said, there's not good ways for people to learn. And so thank you.
If you enjoyed this podcast, please do me a favor and hit the like button and subscribe to receive future episodes. You can find more interviews, articles, and information on sustainable and responsible investing at our website, sri360.com. If you enjoyed this interview and would like to read more lessons learned from world-class SRI investors, Get yourself a copy of my book, Sustainable and Responsible Investing 360 Degrees. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market rate returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 Degrees will be available wherever books are sold from July 2022, but you can pre-order your copy now on Amazon, Barnes & Noble, and Walmart.